Good morning, folks. All right, so this is a stripped down to the chrome review of my ES trade this morning. So we're looking at a weekly chart here. I'm going to dress this up. So this weekly volume balance is what I've had the community, both private and public, watching. So I suspect that the news drivers that we're going to see later this week will be pushing us up into this area up in here and into this area here. Okay, so if there was a sweet spot, it would be this. That's what I'm looking for this week to kind of like trade into that area there. Okay, so what I'm showing you is the difference between this candle's high and that candle's low. And I see people asking constantly, you know, what's the point of using the weekly chart on the front month, you know, nearby the one that's been actively traded, and not use the continuous chart for ES? Well, the advantage is you're going to actually see the volume imbalances that the algorithm will refer to. So as soon as the market trains its eye on the new front month, and obviously June will expiring, you know, next month in June. But when we get into June and we expire, we'll be rotating into the September contract for 2023 for ES and the respective indices, you know, Dow and NASDAQ. But by having the weekly chart on the front month, because we're using the contract month June, so the symbol is ESM 2023. You can see that up here in the upper left. If I were to do it with the ES and just simply did it like this, that's the continuous contract. Do you see it? No, you don't. Okay, so that's the reason why I'm teaching you the way I'm teaching you. I mean, there's no better point than seeing it in the chart like that. Okay, so there are benefits to using a continuous contract, you know, chart for some tools and approaches, but for this purpose, you have to use what I'm teaching you, because the algorithm will refer to these levels because there is inefficiencies there. Okay, it doesn't trade on the basis of a continuous contract. So don't think that you're going to follow the algorithm with a continuous contract, because you're not. It'll be active on the front month. Okay, so all that price delivery is going to be focused on the contract that has the highest amount of open interest and volume. So that's why we're tracking the volume and we're tracking the open interest when we're doing rollover, because to do so, we're going to be closely in line with what the algorithm will be looking to book to and or rebalance and reprice to. So hopefully that's been a sufficient explanation as to why I'm using the contract month, not continuous contract, when I'm looking for weekly volume imbalances. Invariably, someone's still going to be asking questions weeks from now because they're not keeping good notes. But anyway, I didn't want to make this video long, but I kind of like want to make it as concise as possible, but still not as lengthy or wordy. But we have a buy side liquidity pool resting above here, so I'm just going to add all this. This is a little bit extra lipstick that I did not have on the chart, so I'm just kind of, you know, giving you some more insights as to what I expect for this week, because I'm not doing that on Twitter. I will be doing review videos on YouTube, but I'm not going to be, you know, calling anything live. So I'll be working with you all here, you know, each individual day. So let's drop down to a daily chart. All right, so you see that we have our weekly volume imbalance here, and we dropped into this fair value gap. Okay, so if we annotate that, we're inside that range there. Okay, which is also a breaker. We have low, high, lower low, breaker, extend that through. I'm not going to do that. You do that on your own chart. Okay, I want to try to keep the annotations very, very limited, because I could easily light this whole thing up with a whole lot of stuff and quickly lose you. So let's drop into a 60-minute chart. Okay, so you can see how we had the market drop down into that daily, that blue shaded area, that daily fair value gap, anchored here. And then we have these consecutive down close candles, which is a bullish order block. We have a change in state of delivery there. We rally up, the price comes back down into the order block here and taps one more time here on the opening price, which is also the high of that daily fair value gap. Looking at what we have for the week, because of all the uncertainty, all the potential volatility that could be seen by way of all of the price delivery around those times that the market's being manipulated by CPI, FOMC, high impact, medium impact news drivers, all those factors make this week very challenging. So I wanted to go in, focus, look for something early in the week, because it's going to be problematic, where there's going to be a lot of volatility and I may not be on the right side of the marketplace. So my thought process this morning was I went in thinking that I could get something early on and I'll map out what it is I thought I saw and the justifications for all those things. So here's a 15-minute time frame. You can see how we worked on that level again here. And we'll drop into a 5-minute chart. And I'm going to scrunch this up here. And right here, you see that fair value gap? That's not in the recording, but that's why I was trusting the basis of being short and going short. We had a lot of buy side in here. This high, this high, this high, this high. So all in here was buy side. We saw that run up at the open. So at 9:30, we had a big bullish candle trade up into a premium array, which is the fair value gap here. And then, because the fireworks, I think, are going to occur later in the week around the more impactful news drivers, and Monday, today, is rather lackluster in terms of the news. There's really nothing to talk about, really. There's no medium impact or high impact news drivers. So I suspected that we would probably try to create some measure of a run on sell side to wipe the board for anyone that's long, and that would be in the form of taking out the 925 low, the 7 o'clock low, and the London low, trading back down into that daily fair value gap high, ripping down into that there. We're going to drop into a one-minute chart. So you can see how we tore up into that at 9:30. We traded lower, and in working against that low of that weekly volume imbalance, that white shaded area. Okay, so we went up to a premium, we broke lower, came back up into the low of that weekly volume imbalance, which is the white shaded box here. Okay, and I'm going to scrunch it up so you can see it. All of that range up there. Okay, so we dug into it here, treating it as resistance now. We have a balanced price range in here, so I'll annotate that now so we can see. So this is a balanced price range, and I'll make that a little bit darker so it stands out. And it's at an area where we would expect to see it sell off. What's resting below here and below here? Sell side. Okay, and we'll get that in a minute. But I want to show you, using the regular trading hours, this is where that box came from that was like orange. I was showing the closing price on a Friday to the opening price at 9:30. Remember, this is one of the gaps that I utilize in my analysis. So when you see my chart when I was executing, you see this. Okay, so it's regular trading hours, and I'm looking at the settlement price at the closing bell when you watch it on CNBC at 4:15, it's done. They show a 4 o'clock closing bell, but usually it's like a 15-minute rollover. Obviously, it continuously trades till 5 o'clock, but this time window is important. And if you extend it through, you'll see, look at the sensitivity here and here. Okay. So now with that information, we can drop back down into electronic trading hours. That's going to be on our chart. Now we can see it. And the way it looked like that before, let me go back to regular trading hours. Here. I always like to do the extend right when I'm doing like opening range gaps or the variance of the opening range gap, which I've mentioned in lectures. There'll be more detail with it. So, and I understand some of you are impatient and you're just like, can you do this? Can you talk this? I have an itinerary that I'm following. So please don't try to deviate from what I intend to teach and how I want to teach it. It requires patience, I know, and it could be frustrating for some of you, but I have to be on my own schedule. I can't be taken off my own schedule with everybody else's Have It Your Way mentorship. So we have all this run up here, which is a Judas swing. Going into electronic trading hours, now we can see everything's extended, and as the market trades today and into tomorrow, those time windows is important. I like the gap that I just showed you. I like that over the course of 3 days. After 3 days, I lose a little bit of interest in it, but it can be projected into 3 days forward. Okay, so Power 3, all those things coming together with more detail. So the new week opening gap, we're going to go and scrub back into Sunday's opening price. Okay, so that's down here. That's Sunday, 6 p.m. So I'm highlighting that here. I'm going to change the color to black. It's exactly what I do every single time. There is no indicator doing this for me. If you need an indicator to do this, you're friggin' lazy. Okay? It doesn't take that long to do this. Plus, it's allowing you to double check yourself. And high touch is better than high tech in regards to doing this. Because if you have something wrong with your data, the indicator's going to plot on incorrect data. This way you can visually see, are you really checking the right thing? And you can argue and say, well, indicator won't mess up. That's your thought process on it. That's not mine. I don't agree with it. So current new week opening gap low. Text alignment is middle and on the right. And then no boldness. And set to 10. Okay, so current new week opening gap low. And once you have that, you lay your cursor on it till it highlights. Hold down control and then drag it away. And you can copy it and drag it up to the closing price on Friday, right there, the last tick close. And then by doing that, you just double tap that, change that to high. Right, and then you can see the reference points there. I do keep this bold on the boldest thickness, so that's why my chart doesn't look like it normally does until I do this. Okay, so now we have our current new week opening gap high, current new week opening tongue twister, huh? Current new week opening gap low, and then the consequent encroachment is the midpoint. So we'll add that now. So 41.98 and a quarter is the high. Drag that down to 89 even. 89 even. Double tap. Drop that in here for the consequent encroachment midpoint. So 4193.75. So there's the business there. And we'll just drop a line right there. And the thickness. This is what you're used to seeing. And that's consequent encroachment of the new week opening gap. So now we can take that fib off. It's done its job. So I mentioned in the trade while I was doing it, this candle had me concerned because this area here could be just like this, which is a balanced price range. So, and it became just that, a balanced price range. Okay, so in this area here, that's why this gap did not fill. I was taking the chance to see if it would offer it to me, and for the student that was saying, I thought we were only supposed to take fair value gaps after 10 o'clock. No, you can take a fair value gap that forms at 10 o'clock. Okay, I mean, this gap was there. So I'm going to take this off the extend right for a moment. Okay, so inside this area is a balanced price range. So it was likely to leave a portion of this open, but in the event that I was reading it wrong, I had to limit order in here. If it stabbed up in there, it would get me short and then attack the new week opening gap high and then consequent encroachment of the new week opening gap for this present current week. So because of all this, I'm going to take this now off. I mentioned what it was in terms of the balanced price range. This looked like this in the video, and the recording will be executing, and I had limit orders there, and then it broke lower and went down just below that low here. So the sell side below that was just shallow when it hit this right here, one tick below it. And then I used this fair value gap there, and I used the limit order just above that high, which was 4206.25. That candle was my fill. So it went up into this area here, and I showed how I moved my focus here, so that way the folks that would be following along that trade, they could see the logic. And why I felt that we would see the consequent encroachment, we're going to have to go back out to a 15-minute chart, add some lipstick because you won't see it here. So inside the upper range of that daily fair value gap, that's this blue shaded area here, you see how we have price rally here on this candle, and then we rally up through that candle's high, and we open up and run through that one here. So there's a lot of overlapping in this price delivery until we get right there. So at the high of that fair value gap, we have an inefficiency. It's a fair value gap. So if you look at it from this perspective, you have the high and low of those candles. That's your fair value gap. And I'll make this one yellow. And we'll extend it right, and you'll see right away what I'm drawing your attention to. We drop down into that low and consequent encroachment, midpoint of this gap. Also, if we show regular trading hours, it'll look slightly different. So we had that same gap, yes. We have this low and this low. So resting below here was what? Sell side. But because of the day being Monday, and because we have a high impact news driver calendar that's loaded with a lot of different events that could create a lot of the volatility, I'm expecting us to have a range bound day today. So it may not get down here and take that sell side. I mean, they may save it. So I want to use the easiest one, which would be trading to consequent encroachment of the new week opening gap, which is this level here. And it would also trade just to that low here. So that candle's low comes in at 93 even. Consequent encroachment came in at 93.75. So I want to be just one tick below 93.75, which would be 4193.50. Because it may not sweep that low. It may not sweep that low, but it will likely get into the high end of that gap, which comes in at the low of that candle right here at 4192.50. So in terms of spread, that would be 4192.75. That's where my limit order would have to be perfect, to be absolutely perfect. So to remove all that guesswork in here and adding more confidence to what I was trying to do, I finessed the exit just one tick below what I felt that it was likely to reach for. And then I gave up the, was it 1.5 handles of difference between the actual low, and we'll look at it in a second. So that's the regular trading hours. We'll go back in electronic trading hours. And I know right away you're thinking, man, this is a lot of stuff, ICT. Well, this is the way it is, right? I mean, you want precision. I mean, it's going to cost you some effort and it's going to cost you some understanding. And it's why you cannot learn this with 5-minute trainers on YouTube. I'm sorry. It takes some time. So we have all this business here with the previous gap in here. We went back through that one more time. And now we're going to go into a 1-minute chart. Shrink this up a little bit. And all those things being equal, we also have some institutional market structure here. So we have the market showing unwillingness to get up inside here, and when it ran away from that, that's a key level. My bias was already bearish. I wanted to see it take out the sell side here. Where's it going to gravitate to? New week opening gaps. What's the current new week opening gap? It's the high of this one. The midpoint and the low is here. So it's likely to draw down into midpoint. Okay, look at the bodies of the candles. Are they going to consequent encroachment? Yes. What is the closing price on this candle right there? 4193.75. Perfect. Perfect. That's exactly the consequent encroachment level for the current new week opening gap. That's algorithmic. But the market will offer lower prices beyond that, and that's where the damage is done. So notice this price level here, standard deviation -4. Why am I using that? When I was pulling out the fib on this early, before I did the trade, I ran through the series of having all of the standard deviations that were offered to me on the downside from that swing right here. So this is like a trigger. When this low is taken out, you probably hear my son up there, he's flipping out on his PC games. I'm not editing it out, so deal with it. So we have the high to the low. We have a standard deviation of -1, -2, -3, -4. Where's the overlap? We have -3.5 right at consequent encroachment, one tick below that. I like that. And then the next one is 4190 even, which takes us below half of that consequent encroachment of that yellow shaded area, which is the 15-minute fair value gap, which is also at the top of that blue shaded daily fair value gap, which is a discount. Okay, so now watch this low of 4190. What's the candle's low right here? Look right up here. 4190.00. Perfect. But there's no algorithm, right? You're listening to them. So we have that. I'll take that off. And I'll add the executions now so that we can see. There they are right there. You can see all the data. I'll toggle them on and off. You can see it's what it is. I shouldn't have to do that with you all here, but it is what it is, right? And the 93.50 level, you can see it down here. That price is the last 4. So it went 4 at the high of current new week opening gap high, and then 75% of the range from low to high. That's where I had the 2 contracts come off, and then the final came off at consequent encroachment. And I gave up the precision elements that was required down here because I don't want to draw any attention, because there's a lot of people studying my stuff and I don't want them to see what I'm doing down here, but I just explain it to you. Okay. And since then, we've obviously seen the market pull back up off of that, came into the original fair value gap that I mentioned. Now, this is a 1-minute candlestick, and it's right there at the 957 and then 958 and then 959. On this candle here, there was, let me take the executions off so we can clean the chart up. Right there on that candle, that's 10:01. So now at 10:01, where's their fair value gap? Right there. But another one formed, and you watched me do that live in the recording, and then the limit order filled. The high on this candle came in at 4206.50. And one more time, I just want to add the execution so you can appreciate the level of precision that was implemented this morning. The high was 4206.5, and my fill was at 4206.25, which allows for only the spread to fill me. So that's that. So I hope you found this one insightful, and enjoy your day. I'll talk to you tomorrow. Be safe.